Okay, so in our previous session, just a quick recap of what we were looking at in our last session. So for our last session, we did look at relevant cost analysis. So we did look at relevant cost analysis. So for relevant cost, we did mention that for a cost to be relevant, it must be a future cost. For a cost to be relevant, it must result in an outflow of benefits. Sorry, it must result in an outflow of cash. So for it to be a relevant cost, it must result in us losing money. It must result in an outflow of cash. And also we did mention that a relevant cost, we did also mention that a relevant cost must be incremental. So if we are saying this cost is relevant for decision making, so we are looking at that, is the cost is resulting in us losing money in the future? Is the cost a cash flow cost? And also, is it a future cost? Certain costs are not part of relevant costs. Why? Because they've already been incurred in the past. The costs that we have incurred in the past, we gave them the name, the sunk cost. If a cost is said to be a sunk cost, it's a cost we have already incurred in the past, and it's not going to affect our future decision. If you are deciding on whether you should go ahead and do ACCA or not, the fact that you have already done, maybe you have already done part one of ACCA, is no longer relevant, because even if you decide you're not going to go ahead, it's not going to affect that decision. If you have already paid for a certain cost, it's no longer relevant for decision making, because whether you decide not to go ahead with the decision or not, that cost is not going to change. So we did mention that a cost is relevant if it's future, and also if it's going to result in an outflow of money. Then we also talked about sunk costs, committed costs, the fixed costs, depreciation and controllable costs. We also did mention the opportunity cost. So the opportunity cost is the benefit of the next best foregone alternative. If we have not chosen, if you were not maybe in class today, what else could you be doing? So there are benefits you are losing. The benefit could be, you could be sleeping, enjoying your sleep now. The benefit could be you could be doing something else. So the benefits you're losing by choosing a certain decision, that's the opportunity cost. So in decision making, opportunity cost is a relevant cost. We should not lose much benefit. So we consider the opportunity cost. Then the minimum price, we also did mention the minimum price. So the minimum price, if someone is giving us an order, the minimum price should be equal to the relevant cost. So they can't charge us a price which is lower than, they can't, the price should not be lower than the relevant cost. So we first of all calculate which costs are relevant for this order. Then the selling price should be higher than the relevant cost. Then let's move on. We did mention that relevant cost can be calculated for material, for labor, for assets, and in joint product. So for relevant costing, we did also look at how you determine whether material is relevant cost, is relevant. So we say there are questions you ask yourself. Before you can say the material is relevant or not, you need to ask yourself, do we have the material in inventory? You need to ask yourself, is the material regularly used? You ask yourself, is it regularly used? Ask yourself, can it be converted or changed to another type of material? So after that, we did look at the relevant cost for labor, where you ask yourself, is there idle capacity? And also you ask yourself, can we use overtime? And also, can we take employees from another department? But when you take employees from another department, we said that gives rise to an opportunity cost. We lose the benefits we were getting from that department. So I think this is available on the previous recording, so you can go through that if you missed it. So now let's get into today's business. Let's get into today's business. Okay, so in today's business, I want us to start with the cost to volume profit analysis, the CVP analysis. So the cost to volume profit analysis, that's what we have on today's menu. The cost volume profit analysis. The CVP analysis, it can also be given the name break-even analysis. So if we are dealing with the CVP analysis or the break-even analysis, this is used in the case that the business is operating. In most cases, we use it if you're operating in a stiff environment, or maybe economically things are down, the economy is at depression. So we are just operating to survive. So we want to operate simply so that we can survive. We are not concerned about making a profit. We just want to make sure from the selling price we have charged, we are able to recover our cost from that selling price. It will enable us to pay for the expenditure of the business. So we want to identify at what production level can we say now the cost of production is now equal to the revenue that we are getting, or to the profit that we are getting. So let's start by understanding the break-even point. So the break-even point, this is the point where the total cost of the business, the break-even point, is the point where the total cost of the business are equal to the total revenues. So if you're operating at break-even point, the total costs are equal to total revenues. If you're operating at break-even, the total cost of the business are equal to the revenues. So take note, if we are looking at the total cost of the business, total cost comprises of, so we are saying if we add the variable plus the fixed cost, the variable plus the fixed cost are equal to the total sales. So if we add the variable and the fixed cost, they will be equal to what we are getting from the selling price. So if we sell something, the amount we get is equal to the cost of production. So meaning at break-even point, there is neither a profit nor a loss. At break-even point, the firm neither makes a profit nor a loss. If you're operating at break-even point, your costs are equal to your revenues. You neither make a profit nor a loss. If you're operating at break-even point, you neither make a profit nor a loss. So for us to identify the break-even point, there are assumptions we have to make. So for you to come up with this point where we neither make a profit nor a loss, the assumptions are, the first assumption is that all units produced are going to be sold. Production is equal to sales. All units produced will be sold. So in order to determine this break-even point, the first assumption is everything that we produce, we must sell it. So all units produced are going to be sold. That is the first assumption. And the other assumption is that the total fixed cost will not change for the level of activity. So that's the other assumption, that our fixed costs in the business, they are not going to change. So the first assumption is that everything we produce, we sell it. The other assumption is the fixed costs will not change. Why are they classified as assumptions? It's because in some cases, it's not true. In some cases, it's not everything we produce that we're going to sell. That's number one. Then also in some cases, the fixed costs, of course, they are fixed, but they can change. If you look at like rent is fixed, yes, but the landlord can increase the rent. So the assumption is that these total fixed costs are going to remain the same for that period. Then also the variable cost per unit and the selling price per unit is not going to change. So we assume that the customers are not going to be given discount. So the variable cost per unit, or we can say the variable cost per unit and the selling price will remain constant. So for us to come up with the break-even graphs or the break-even formulas, the assumption is that we are not going to give discount to our customers. If we have a certain selling price, that is the selling price we are going to use. We are not going to discount. So there is no room for discount. All units are going to be sold at the same price. Then lastly, the other assumption is that the firm is dealing with a single product. Or multi-products with a constant sales mix. So the other assumption is that we are selling only one product, or if we're selling more than one product, we are selling these products with a constant sales mix. What does a constant sales mix mean? A constant sales mix, it means when you sell maybe 5 units of A, you also sell 6 units of B. The products, it's a constant ratio. You know that every time when you sell one, maybe you can say maybe you're selling cars together with maybe modulators. So for every car that you sell, you're also going to sell one modulator. So that's a constant sales mix. You know, for every one car, there's also one modulator. Or if you are selling maybe extra spare wheels, you can say for every car you're selling, you are also giving them 2 spare wheels. So there is a certain ratio in which you are selling your products. So that sales ratio must not change. If we are to calculate the break-even point, There must be one product, or it could be multi-products, but they should use the same sales mix ratio. Let's move on. Then from there, when you are determining this point, which we are saying you are operating where you neither make a profit nor a loss, the point can be determined in units or in sales value. So the break-even point can be determined in units, or it can be determined so the break-even point, it can be determined in units, or it can be in sales volume. So this point where we are operating, neither making a profit nor a loss, we can determine this point using the units produced, or we can also determine this point using the sales we have made. So the break-even point, again, it can be shown using a graph. So the break-even point can be shown by calculations. Can be determined by formulas, or we can say by calculation using formulas, or using the graph. So we can use extrapolation, that's using the formulas, or we can use the graph. So let's start with identifying the break-even point using formulas. Again, the issue to take into consideration is, are we dealing with a single product or a multi-product environment? So in most cases, a lot of you might have done a single product break-even before, maybe high school or maybe in your other lower levels. So for a single product break-even, it's not a big deal. But a multi-product break-even might be a new thing for most of you. So let's start with the break-even point, break-even formulas for a single product. So the break-even formulas, if we are dealing with a single product. So if we are dealing with a single product, the first formula is calculating the break-even point in units. So the first formula is calculating the break-even point in units. So determining the break-even point in units, the formula is fixed cost over contribution per unit. So the break-even point in units, that's the fixed cost over contribution per unit. The fixed cost over contribution per unit. Then the contribution per unit, it might not be given. So it's assumed you know this one. So to determine the contribution per unit, the contribution is the profit before taking into account the fixed cost. So this one, you say the selling price minus variable cost per unit minus variable cost per unit. So the break-even point in units, you are taking the fixed cost in total. Is the fixed cost in total. You divide by the contribution per unit. This will tell you how many units you need to produce for you to neither make a profit nor a loss. So at this level, if the business is producing at this level, the sales we are getting are equal to the costs. We are neither making a profit nor a loss. So if you're operating at break even, we are balancing the costs and the revenues. There is no room for profit. Then let's move on. So we have the break-even point in units. Then let's move to the break-even point in sales revenue. So if it is the break-even point in sales revenue, we are saying in terms of sales now, how much sales are we supposed to make for us to neither make a profit nor a loss? How much sales are we supposed to make? So the break-even point in sales revenue, the formula then becomes, so the break-even point in sales revenue, you can take the break-even point in units you got above. So you can say the break-even point in units times the selling price. So if you take the break-even point you got in units and you multiply that with the selling price, it can give you the break-even point in sales revenue. Or optionally, you can say the fixed cost over contribution to sales ratio. So to get the break-even point in sales revenue, you can say the fixed cost over contribution to sales ratio. The fixed cost over contribution to sales ratio. So after calculating the break-even point in sales revenue, the next calculation you need also to be able to determine, in most cases, is the margin of safety. So the margin of safety is saying, by how many units have you exceeded the break-even point? How many units, by how many units are you safe? If you produce above the break-even point, you are safe as a business. But by how many units? So the margin of safety is looking at by how many units have you exceeded the break-even point. Units, the more the margin of safety. So you say the total production minus break-even production. So this will give us by how many units. This is the margin of safety in terms of units. Margin of safety in units is the total production minus the break-even production. If it's in sales, it's the total sales minus the break-even sales. So that's the margin of safety. We are simply saying by how many units have we exceeded the break-even, or by how many sales have we exceeded the break-even. Then lastly, the number of units to reach a targeted profit. Number of units. They can say determine, we are targeting a certain profit. So the number of units to reach a targeted profit. So we're saying, how many units should we sell so that we just make a profit maybe of 12,000? That's what we're targeting. So the number of units to reach a targeted profit, we can say fixed cost plus the targeted profit. So the fixed cost plus the targeted profit over contribution Fixed cost plus the targeted profit over contribution per unit. Fixed cost plus the targeted profit over contribution per unit. Fixed cost plus targeted profit over contribution per unit. So this will tell us the number of units required to reach a certain targeted profit. Then, so this was for a single product. This was for a single product. Now let's look at multiple products. Multiple product. So if it's now multiple product, if it's now multiple product, it means we're not just dealing with one unit, we are selling different products. So if we are dealing with different products, the rule is there must be a constant sales mix. If you are dealing with different products, the ratio at which you are selling the products must be the same. So for multiple products, there must be constant sales mix. If the firm is dealing with multiple products, there must be a constant sales mix. Meaning for every a certain number of units for X, you should also sell that same proportion, the proportionate number of units maybe for Y. So you should be selling your products in a certain ratio. So the formulas are almost the same, but there are slight changes. So the first one, if you're calculating the break-even point, this is common. They are likely to give you questions for multiple product environment. So the break-even point. So for the break-even point, fixed costs over weighted average contribution. Fixed costs over weighted average contribution. That's the break-even point. Fixed costs over weighted average contribution. Fixed costs over weighted average contribution. That's getting the break-even point in units. The first one is break-even point in units. Then the other one, break-even point. In sales revenue. So the break-even point in sales revenue, the formula, that's fixed costs over weighted average contribution to sales ratio. So it's over weighted average contribution to sales ratio. So I will show you how we work out the weighted average contribution and the weighted average contribution to sales ratio. Then the last one, we're going to have the number of, even the margin of safety, you can still work it out the same way. So for margin of safety, it's still the same. You say the total production minus the break-even production. or the total sales minus the break-even sales. Then for the number of units to reach a targeted profit, if it's a multiple product environment, number of units to reach a targeted profit. So the number of units to reach a targeted profit. How do we work this one out? So for the number of units to reach a targeted profit, we are saying the fixed cost plus that targeted profit fixed cost plus that targeted profit over weighted average. So for multiple products, we are not just saying contribution, but it's weighted average contribution per unit. So it's weighted average contribution over weighted average contribution per unit. Okay, so it is over weighted average contribution. Now let's apply this to a question. So let's start with the first case of a single product. We just do one example and the same for multiple products. So the question will not indicate it's a single product, but the structuring of the question is different from that of a multiple product. The company makes product P and the following information has been provided. For production level of 30,000 units. Each unit is being sold just a moment. So each unit is being sold at $12. Each unit is being sold at $12. And the variable cost of producing each unit amounts to $7 each. The total fixed costs for the period were 60,000. The total fixed costs for the period were 60,000. What is the break-even point in unit? What is the break-even point in units? What is the expected profit? Then next, what is the margin of safety as a percentage? What is the number of units required to reach a profit to reach a targeted profit of to reach a targeted profit of 82,000. So the product being sold is just a single product. So for the first calculation, the break-even point in units shouldn't take us time. The break-even point in units, that's our fixed costs in total. We're told the fixed costs in total, I think that's 60,000 over our contribution. Contribution is the selling price minus the variable cost. That's 12 minus 7. So our contribution per unit is the selling price minus the variable cost. So that's 60,000 divided by 5. 60,000 divided by 5, that's 12,000. So it means we break even at 12,000 units. For us to break even, we just need to produce 12,000 units. Then at 12,000 units, we are neither making a profit nor a loss. So we just need to produce 12,000 units. Then at that level, we are neither making a profit nor a loss. Then let's move. The next question, what is the expected profit? So if we are now looking at the profit, in this question, they've not the targeted profit, just the profit. So the profit, remember, for us to make profit, the selling price must be greater than the cost. So if they ask you for the total profit or expected profit, you can then say the selling price minus the total cost. So this will give us the profit. So our selling price, we were given this per unit, but for the profit, we are saying the selling price for, if we sell all the units, not the selling price, maybe the sales. That's if you take the units we are expecting to produce, that's 30,000 times the price per unit, 12. This will give us overall what we are expecting to get. If we sell all these units, what are we expecting to get? Minus the costs. So for the costs, we have the fixed costs which were given, but the variable cost is 7 per unit times the number of units. So the total cost, you say the variable cost plus the fixed costs, which were 60,000. This can give us the profit we are expecting. So the profit we are expecting here, that's 30,000 times 12. That's 36,000 minus, what do we get here? That's, that's 270,000. So we're saying 360,000 minus 270,000. So 360,000 minus 270,000.
That's 90,000.
Sorry?
90,000.
90,000. So it means the profit currently is 90,000. Then what is the margin of safety? Our margin of safety, we are saying by how many units are we safe? So margin of safety, we break even at 12,000 units, but currently our production is 30,000. So margin of safety as a percentage, we start by getting the margin of safety units. So the margin of safety units, we are saying all the units we are producing, which is that's 30,000, minus the units to break even, which is 12,000. So it means our, in terms of our units, we are safe by something like 18,000. So these are units. So we are safe with something like 18,000 units. Then margin of safety as a percentage. So margin of safety percentage. So the margin of safety percentage, you then say your margin of safety over the total production times 100. So margin of safety over total production, that's 18,000 over the total units expected. We put that as a percentage. So that's 60%. Let's proceed. Let's proceed. So the margin of safety, then besides the margin of safety, the number of units to reach a profit of 82,000. To reach a targeted profit. So to reach a profit of 82,000, the formula is targeted profit, so it's the number of units. In this case, is equals to our fixed costs, which is 60,000, plus the targeted profit, 82,000, over the contribution, which was 12 minus 7, which was 5. So in order to reach that targeted profit, we have to sell that 60,000 plus 82,000 divided by 5. So it means we need 28,400 units. To reach that targeted profit, we need 28,400 units. So for a single product, it's not much of a big deal. Let's now get to a multi-product. Multi-product. So multi-product, this is where now you are dealing with more than one product. So let's have an example again for a multi-product environment. KD Limited sells 2 products. X and Y. So sells 2 products, X and Y. The selling price is $20 and $15 respectively. 20 and 15 respectively. Two units of Y are sold for every unit of X. Two units of Y are sold for every unit of X. Two units of Y are sold for every unit of X. The variable cost per unit for X is 10. And for Y is 7. The variable cost for X is 10, and for Y it is 7. The total fixed cost for the period. The total fixed costs for the period are you can say the total fixed costs for the period, they are 90,000. Then required, calculate the first requirement, calculate the break-even point in units. The second requirement, the break-even point in sales revenue. Next question, the number of units. to reach a profit, the number of units to reach a profit of 40,000. Number of units to reach a profit of 40,000. D, if the total revenue is, if the total revenue is if the total revenue is, let's just say 400,000, what is the break-even point? So what is the margin of safety? As a percentage. What is the margin of safety as a percentage? Okay, with that information given, let's now go and do our calculation. So the first calculation here, our first calculation here is being able to determine the break-even point in units. But the question is mentioning we are selling two products, product X and product Y. So in this case, it's more than one product. It's a multi-product environment. So in a multi-product environment, we sell more than one product. So if you're selling more than one product, the first step here, we need the okay, just a moment. Can I answer that? Hello. Come on, Kase. And the vehicle office. 7th from Globe 51 house. Okay, so let's proceed. The break-even point in units for a multi-product environment. So the formula here, we need fixed costs. So for the break-even point, we need the fixed costs, which we are given. If we go to the question, the fixed costs are given. It's 90,000. So for the fixed costs, we have 90,000. But we have to divide the fixed costs with our weighted average contribution. We have to divide the fixed costs with the weighted average contribution. So the weighted average contribution, in this case, is not given. We can calculate contribution, but weighted average is not given. So let's work out the weighted average contribution that we need. So calculating the weighted average contribution. So if you're calculating the weighted average contribution, we're going to consider we have our products X and product Y. So for product X and product Y, contribution, remember, is the selling price minus So we're going to need the contribution here. Contribution for X, you're saying the selling price minus the variable cost. For Y is the selling price minus the variable cost. So for X, it's 20 minus variable cost of 10. So 20 minus 10, that would give us a contribution of 10. Then we come to Y, 15 minus 7, that would give us something like 8. So contribution for X is 10 per unit. Contribution for Y is 8. After you've gotten the contribution, you then put your mix. What is the mix ratio? The question was specifying that when you sell, if we go to the question, 2 units of Y are sold for every unit of X. So the sales mix ratio is 2 units of Y for every unit of X. So 2 for 1. 2 units of Y for every unit of X. So it means this side we sell 2, this side we sell 1. So that's our sales mix ratio. 2 units of Y for every unit of X. Then we get our total contribution. So we are saying whenever we sell X, we get a contribution of 10. So when you sell 1 unit of X and 2 units of Y, what's your contribution in total? We have 10 for X. Then we have 8 times 2 units. So from the side Rawai, you get a contribution of 16. And from the side of X, you get a contribution of 10 when you sell in one transaction. So it means in total, what's your contribution? From X, you have made a from X and Y, you have made a contribution of 26. But how many units have you sold altogether? The units you have sold 1 for X and 2 for Y. You have sold 3 units. So the weighted average contribution you say the total contribution over mix, total mix. Total contribution over total mix. So the total contribution is 26. Total mix is 3. So we can then say our average contribution per unit is $8.67 per unit. That's our weighted average contribution. So the break-even point, you say the 90,000 over the 8.67. Our break-even point then becomes 90,000 over so our break-even point, it means we have to sell for our break-even point, we have to produce and sell 10,381 units. So in order to break even, we have to sell 10,381 units. So we might need to split these units. There may be need for us to split these units. So our break even in units is equals to these are the units we need to sell in order to break even. But we can split this to say, okay, for these units, how many units for A and how many units for X and how many units for Y? So from these units, the units of X that you need to sell, then units of Y. So in total, there are 10,381. But you can split this into units of X and units of Y. Can split this into units of X and units of Y. So how do you do it? You split based on the ratio. You split based on the sales mix ratio. So the sales mix ratio was 2:1. So you want to split 10,381 in the ratio 1:2. So it means for X, it would be 1/3. Then for Y, it would be 2/3. So in terms of how many units for each, the nearest whole number, that's 6. 3,460 for X, 6,921 for Y. So that's if you're calculating the break-even point in units. Then besides the break-even point in units, we can be required, like the second question was saying, what is the break-even point in sales revenue? So if it's now the break-even point, in sales revenue. For break-even point in sales revenue, using the formula where we use contribution to sales ratio, we say, so for you to get the break-even point in sales revenue, we say the fixed cost over the weighted average contribution to sales ratio. Weighted average contribution to sales ratio. So the fixed cost tangataka pure on the question. So the fixed cost Tatoisa is 90,000. But what we need to work out now is the weighted average contribution to sales ratio. So weighted average contribution to sales ratio, calculating the weighted average contribution to sales ratio. Calculating the weighted average contribution to sales ratio. So if you are calculating the weighted average contribution to sales ratio, the first step is similar to what we did. We need X and Y, these are our units. Then we need our contribution. Let's start with can still work though. So our contribution, it was 10 here. Then it was 8 this side. This was contribution per unit. So we get our contribution per unit, then you get total contribution. Remember how we get the total contribution? You're multiplying with the mix. So the mix was 1 here. So it would be still 10. So maybe let me drag this and do this. It was 1:2. This is the mix. So 1 times 10, that's 10. 2 times 8, we say that's 16. The total contribution was 26. We do the same for sales. You say the sales selling price per unit. Or the sales, rather. So if you sell 1 unit at each unit was going for 20. Each unit was 20 times 1, or each unit this side it was 15. So this is for 1 unit. In total sales. So for total sales, you're saying 20 times 1, that's 20. 15 times 2, that's 30. So in total, our sales, we're going to get sales of 50. So in every transaction, we get sales of 50, and we get a contribution of 26. Then after that, the contribution to weighted average contribution to sales is going to be then the contribution 26 over the total sales 50. So our weighted average contribution is 26 over 50. Which is 0.52. So having our work, we then go back now to say our break-even point in sales revenue. Our break-even point in sales revenue is you divide by 0.52. So in order to break even, we have to make sales of this much, of $173,076. So in order to break even, these are the sales we should make. So that's the break-even point in sales revenue. Then the next question is the number of units to reach a profit of 40,000. The number of units to reach a profit of 40,000. So the number of units to reach a profit of 40,000, you'd say the fixed cost 90,000 plus the targeted profit 40,000 over our weighted average contribution per unit. We have calculated this. The weighted average contribution per unit. So our weighted average contribution per unit was 8.67. That's what we're using. So we divide by 8.67. So in order to reach that required level of profit, we have to make 14,994 units. So to reach the targeted profit, these are the units we need to produce and sell. So the number of units to reach that targeted profit, that is the number of units we need to produce and sell. Then from there, the other question was saying, what is the margin of safety as a percentage? So we are given the total revenue. So we are told the total sales are 400,000. What is the margin of safety as a percentage? So the margin of safety, in this case, we are given revenue. So we first of all calculate the margin of safety in revenue. Last time we did calculate it in units. This time we are calculating in revenue. Margin of safety in terms of revenue is just the total sales minus the break-even sales. So it's the total sales less the break-even sales. So in this particular case, you are taking the 400,000 as your total revenue minus the break-even revenue. So the break-even revenue we calculated on top, the break-even revenue was something like 173,000. 070 173,070 173,070. Is it 070 173,077, not 07? Are we still together?
Yes, sir.
Okay, so it means our margin of safety is it's 400,000 minus 173,077. So our margin of safety, this is in revenue. This is our margin of safety in revenue. But the question is saying as a percentage. So as a percentage, you then say your margin of safety in terms of revenue over the total revenue. You express that as a percentage. You express that as a percentage. So that's something like 57%. So your margin of safety in sales revenue, it's like 57%. So that is if we are using the graphs. So if we are using the formulas. So graphically, we can also show the break-even point. So we can also show the break-even point using a graph. So there is a break-even chart which can help us identify the break-even point. So we have a break-even chart which can be used to visualize the break-even point. Sorry, it's not. Sorry, it's failing to show there. Okay, so with the break-even chart, I'll send the one that I had downloaded there is failing to open. Okay, however, I will just send you the diagram in the group. So let's not delay on that, because on the break-even diagram, what is just important to take note of is understanding which point is our break-even point. So we can say interpretation of the break-even. Interpretation of the break-even graph. Just a moment. So interpretation of the break-even chart. So if we are looking at the break-even chart, where total costs line meet the total revenue line. So where the total cost line meet the total revenue line, that is the break-even point. In the exam, they can't say draw that but they can require you to interpret, maybe identify which point is the break-even. So the break-even point is where the total cost line meet up with the total revenue line. Then also another thing to take note of, the fixed cost will be a straight line. The fixed cost will be a straight line. The fixed cost will be a continuous straight line. The total revenue line starts from zero. The total revenue line why? Because if you don't sell anything, you make a revenue of zero. So the revenue that you make depends on the amount of sales. So the total revenue line starts from zero, meaning that if you don't sell anything, you make zero revenue. Okay. Then the total cost line starts from the total, the fixed cost line. So I'll just show you I'll send you the diagram to visualize that, but it's not a big deal really. We can't spend a lot of time on it. Then, because we are behind time, let's move to the next topic. So we're now moving to the limiting factor. Planning with the limiting factors. But before we get to there, let me give you a question to just test your understanding. Let me give you a question on what we have been doing. Just one to test your understanding. Quickly, can you attempt number this question on the screen? Just giving you a few minutes to do that. Number 82. Sorry, I'd gone out briefly. Hope you didn't ask anything in my absence. So can you quickly attempt that? Quickly, please, so that we can move.
Okay, done, sir.
What did you say?
I was saying I'm done.
Okay, what did you get?
I got 22,500 B.
22,500, yes, I think that's correct. So you attempt more questions for practice. So let's move to the next topic, limiting factor. So limiting factor analysis. If you're saying there is a limiting factor or a bottleneck factor, it means there's a resource which is in short supply. So a limiting factor, it's limiting us from getting to the level that we want. So if there is a limiting factor, we are failing to get to the exact point where we want to get to because there is a resource which is in short supply. So the resource which is in short supply, it could take different forms. It could be labor, it could be material, it could be space. So a limiting factor is a resource which is in short supply. A limiting factor is a resource which is in short supply. If we are looking at a limiting factor, it is a resource which is in short supply. So that which is limiting us from reaching the point that we want, that's a limiting factor. So our limiting factor could be that resource which is limiting us, it could be material. So the capacity is there. We do have the machines, but the source of material is not available. So maybe the suppliers are not getting the materials that we need. So we are, in most of the cases, we have machines that are lying idle because we don't have the material required. So material could be a limiting factor because we don't have the material, but the machines are there. We can produce if we were to have the material. So what is limiting us to operate at our full capacity is material. That's number one. We can also have labor. Labor time could be a limiting factor. So if we are maybe dealing with a labor-intensive environment, we might have shortage of labor. We might have a shortage of labor, which can restrict us from also operating at our maximum capacity. So labor could also act as a limiting factor. Then besides labor, another limiting factor could also be the machine time, the machine hours. The available machine hours could act as a limiting factor. We could have also even the factory space could also act as a limiting factor. So we are simply saying a limiting factor is anything that is preventing us from maximizing our output, from producing to our maximum ability or capacity. That is a limiting factor. So if we are faced with a limiting factor, the same way we're dealing with under the CVP analysis, we're saying we can have a single product situation or a multiple product. The same also happens this side. We have a single limiting factor or a multiple limiting factor. So the limiting factor could be a single limiting factor, or it could be a multiple limiting factor. So let's have that point down. The limiting factor or the firm can be first. Lisa, the firm can be first with a single limiting factor or a multiple So the firm can be faced with a single limiting factor or a multiple limiting factor. The firm can be faced with a single limiting factor or a multiple limiting factor. So if there is a single limiting factor, we're saying it's only one resource. It could be only material that is limiting us. It could be labor that is limiting us. It could be only machine type that is limiting us. Or it could be the factory space that is limiting us. So if there is a single limiting factor, it's only one resource that is limiting us from reaching our maximum capacity. So if there is a single limiting factor, it is only one resource that is limiting us. It is only one resource that is limiting us. But for multiple limiting factors, it's more than one resource. So let's start with a single limiting factor. If it's a single limiting factor, let's think of material. So if it's material, that is a limiting factor. We need to, if we have a single limiting factor, we need to produce first the products that are giving us the highest benefit from that limiting factor. So let's say material is a limiting factor. We say, okay, for these products, which one is, okay, let me maybe, let's not use material. Let's think of labor time. You are being required in three companies. Company A wants your labor. Company B wants your labor time. Company C wants your labor time. It's you, they want to hire you. Company A, B, or C. Then company A is saying, we want you for, let's say, the hours and the pay. So the hours and the pay. Just a moment, I need to respond to something. So we have, I was giving an example that you are being required at company A, company B, and company C. So you're being required at company A, B, and C. Company A, they want you for per day. They want you for 10 hours. Company B, they want you for 8 hours. Company C, they want you for 6 hours. Maximum time you can work is 10 hours. That's your maximum in a day. You can work 10 hours maximum. But these companies, they want you for A, B, and C. They want you to work for them. So the problem here is that the time you have, it's not enough for you to work for A, B, and C. So you'll be faced with a decision to choose one company or two companies, but leave out the other. So this is the situation we'll be faced with in limiting factor. So you then say, okay, how much are they going to be paying me for company A in those 10 hours per day? So company A can say, we are going to be paying you 120 per day, $120 per day. Then company B can say, we'll be paying you 104 per day. Company C can say, we'll be paying you $90 per day. So you are now faced with the decision of where should you put your labor time? The labor time is limited. If I could work in A, B, and C, it would be good. I could get the 120, the 104, and the 90, all of it. But the problem is that my labor time is limited to 10 hours. What then should I do? The most ideal situation would be to say, okay, my labor time is in short supply, so it's precious. My labor time is precious, so I need to determine how much are they paying me per hour. So I need to check, okay, for company A, they are saying 120 for 10 hours, but so per hour, how much are they paying? Then I say the 120 divided by 10, which means that for this company, they are paying me something like $12 per hour. $12 per hour. Then this one, they're paying me something like 104 for 8 hours. That's something like $13 per hour. So the first one is $12 per hour, $13 per hour. Then this one, something like $15 per hour. So you divide the price that they are giving you divided by the number of hours. So before you can say, no, A is giving me a lot of money, consider how much are they giving you per limited resource. Since labor is a limited resource, you have to use it wisely. You can't spend your 10 hours working for A, getting the low rate per hour as compared to the other companies. So what would be the most ideal situation here? As a rational person who would want to maximize benefit, you'd choose to go and work for C first. You use your 6 hours working for C. Then if you still have any extra hours, like in that case, you will be having additional 4 hours. You can then go and use your additional hours for B. And rather you choose not to go for A. Why? Because your labor is precious and is limited. So start with the company that's giving you the highest pay per hour. You then move to the next one. Then if the hours are not enough, you rather sacrifice not working for A. So you now rank. That's now ranking the companies. So we do what we call ranking. So you say this is rank number 1. This is where you put your, you firstly put your labor time. Then you come to B, you rank number 2 because it's second in terms of giving you more per hour. Then this one is you rank it number 3. So the most profitable option is to start with the one that gives you more per limiting factor. So you can say if you can say the limited resource must be apportioned in the most profitable order. The resource or the product, in this case, let's take A, B, and C as products. The product giving us the highest, the product giving us the highest profit. The salary in this case is the profit. The highest contribution. Let's use contribution. The limiting factor is the one we start with. The product giving us the highest contribution, the limiting factor, is the one we start with. So from the example above, you'd rather sacrifice A. If A was a product, you'd rather not produce A and focus on the products that are giving you more profit per limited resource. It means if you were to allocate your time wisely, so if you decide to allocate your time to A, the 10 hours would give you 120. But what if you are to maximize, or you can say use the optimal production plan? The optimum production plan is the one that maximizes profit. So if you use the optimum production plan, it means that you would take for company C first, you'd start with company C. For company C, you would work your 6 hours and you'd get your $90 at $15 per hour. You then go to your company B with the remaining 4 hours. So with the remaining 4 hours, you work for B, getting $13 per hour. So it means for company B, for those 4 hours, you are going to get, that's 4 times 13, get $52. So the total, your total will then be 142. So if you use the optimum production plan, or first of all, identifying the resource giving me the highest profit per limiting factor. It means that you are likely to get more. So maximizing the benefit or choosing the optimum production plan, you are looking for the one that will give you the most benefit. There are limited resources, yes, but which order would give you the most benefits? Steps when dealing with a limiting factor. Steps when dealing with a single product. Limiting factor. So step number one is to determine which resource is the limiting factor, which resource is in short supply. So the question can give you different resources. It's up to you to determine which one is the limiting factor. So if it's material, you consider for the units that we want to produce, how much material do we need and how much do we have? If the material that we have is enough or is more than what we need, then that one is not a limiting factor. So you can say the first step is determine from the resources given which one is a limiting factor. Determine from the resources given which one can we say is a limiting factor. So from the list of resources they've given us, which one can we say this one is a limiting factor? So how do you identify it? Tati, you identify it because it's not enough. The resource that is needed is more than what is available. So after you've identified which resource, is it material, is it labor, is it machine time? After you've identified the resource in short supply, the next step is to calculate the contribution from each product. They'll give you a number of products, so you calculate the contribution from each product. After calculating the contribution from each product, that's more like the steps we did above. The first step was determining which resource is a limiting factor. It was our labor time. Then calculating the contribution from each product, it was more like calculating the pay from each company. Then after calculating the contribution from each product, you then calculate the contribution per limiting factor. Contribution per limiting factor. This is where you're dividing the pay over the hours. You're dividing the contribution divided by the limited resources. So after you determine the contribution per limiting factor, you then rank your product. Then after ranking, you then determine the optimum production plan. You determine the optimum production plan. So you determine the optimum production plan. Let's just check if we can get a close question to demonstrate that, then we move. So let's read through this question. A company has the following production planned for the next 4 weeks. The figures reflect full capacity. The level of operations planned output is equal to the maximum demand of the product. Then, if we go below, the direct labor force is threatening to go on strike for 2 weeks out of the coming 4. This means that only 2,160 hours will be available for production rather than the usual 4.320. This one, they've done step 1 for us. They've already determined for us which resource is a limiting factor. So they've mentioned that the labor time is going to be less than the usual. So our limiting factor in this case is most likely to be the labor time, because the question has stated that the workers are proposing to go on, the workers are proposing to go on a strike. So meaning that the labor time available is going to be reduced. Okay, so step 1 has been done for us. So step 1, we've determined so that's from the kit. So step 1 is to determine which resource is in short supply. So you can say the labor time is the limiting factor. The labor time is the limiting factor. Then step number 2 is calculating contribution per unit. So calculating contribution per unit from each product, we need a table. So we have product A to D. So we're going to say the selling price minus the total variable cost, or optionally. So contribution, you can get it in 2 ways. So we have product A to D. Sorry, can I just take that? Hello. All right. Just a moment. Just a moment. Okay, let's proceed. So I was saying we were given, let's go back, was it product A today? A, B, C, D? A, B, C, D. So the first thing, we need to work out our contribution. So I was saying that for contribution, there are two approaches. We can say selling price less the variable cost. You can take your selling price, deduct all the variable costs, you get contribution. Or optionally, contribution, you can get it by just saying the fixed cost, the profit plus the fixed cost. Let's go to the question and see what we have been given. So you can take the profit, you add back the fixed cost. Or you can say 160 minus all this. Or just take this, you add back the fixed cost, you get the same amount. So to say the profit plus the fixed cost, or the selling price minus the variable cost, you get the same amount. So for A is as 30 plus 16, that's 46. That's 52. So we have 46. We have 52. We have 46, so 52. Then we have 13 plus 8, that's 21. Then we have that's 60. So we have 21 and we have 60. So the first step is to work out our contribution. Our second step, rather, is to work out our contribution. Then the next step is the contribution limiting factor. So we've calculated that A is giving us a profit of 46, B a profit of 52, C 21, D 60. But now we want the profit that it is giving us per limiting factor. So that's the contribution per limiting factor. So the contribution per limiting factor, in this case, our limiting factor, our limiting factor is labor time. So you'll be saying each unit of A is giving you $46 profit. But each unit of A requires how many hours of labor? Each unit of A requires, if you go to the question below there, we have the labor time. So each unit of A is going to give you $46, but after using 6 hours per unit. So the first one is 6, the other one is 8, 3, 2. 6, 8, 3, 2. So this one, 6. This one, 8. Was 6, 8, what, 3, 2. So it means for every hour, this is the contribution we are getting. For every hour, this is the contribution we are getting. So our contribution per limiting factor, we then rank the contribution per limiting factor. So in ranking the highest contribution per limiting factor, we rank that number 1. You rank this one number 2. You rank this one number 3. Hello? Yes. Bakashat. So that's it.